Westfield has announced a major restructuring which it says will unlock value for its shareholders. Half the group's Australian and New Zealand assets will be tipped into a new listed trust, which will be accompanied by a $3.5 billion capital raising. In a moment, we'll hear from Chairman and Founder Frank Lowy, but first, this report from Andrew Robertson.
This is not the first time Westfield has changed its structure to suit its goals.
We are proposing to create a new investment vehicle to be known as the Westfield Retail Trust, which will become partner with the Westfield Group.
Westfield Retail Trust will contain half of Westfield Group's 54 shopping centres in Australia and New Zealand. It's hoped it will start life with nearly $11 billion in equity, made up of a distribution of units to existing Westfield Group investors and a capital raising of $3.5 billion, which will be used to pay down the debt attached to Westfield Trust centres. However, for at least one Westfield security holder, the benefits are hard to see.
The upside is being promised on is a promise of returns that will differ, and also a lower cost of capital to the entity, but that comes at a cost.
That cost is the $200 million in advisors' fees and other charges to establish the new Westfield structure, and the fact that investors who don't take part in the public offer part of the capital raising will have their holdings diluted. Lincoln Share Market Solutions Head of Investment Research, Dennis Ng, says there's also some downside from the move away from the single Westfield Group created in 2004.
It comes up with a lot of questions, I think, because a lot of the benefits which you would have expected the company to reap from the combination in 2004, a lot of it's going to be lost in the process now.
Dennis Ng believes the main reason for the revamp is to position Westfield Group for an aggressive acquisition phase, and he thinks Centro will be high on Westfield's list of targets.
There's obviously a lot of other possibilities out there, but I think Centro is the one which really screams out to us as something that's definitely worth a look into, just because these may be possibly distressed assets going for less than perhaps they would be worth normally.
Maxim Asset Management's Winston Samet agrees that expansion could be the motive behind Westfield's new strategy.
They believe the structure is suitable for current conditions, and that in terms of cost of capital it'll be better for the group as they access capital around the world.
We believe that there's a strong investor demand for a trust like this, one which is focused on investing in Australia and New Zealand retail property.
One of those assets Frank Lowy believes will be in big demand with investors is Westfield's new Sydney CBD shopping complex. It will be the flagship asset in the Westfield Retail Trust, with Westfield Group guaranteeing a yield of nearly 6% for the first 3 years. Westfield Group Managing Director Stephen Lowy isn't overly concerned by the current softness in retail sales figures or the latest rises in interest rates.
This year we've had more than 5% compound growth in like-for-like sales over a 5-year period of time. So there's a very healthy underbelly to the state of the retail environment.
For Lowy's plans to split Westfield Group in two will be put to a meeting of security holders on the 9th of December.